Anthony Grasso here, bringing you financial news you can use. In this video, I'm going to do a stock analysis on entertainment arts. Is this gaming growth stock still worth investing in 2021 and beyond? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell for your daily stock reviews and recommendations from an unbiased source. So let's get right into it. So this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you can get 2 free stocks by using my referral link in the description down below. All right, so Electronic Arts develops, markets, publishes, distributes games, content, and services for game consoles, PCs, mobile phones, and tablets worldwide. Now, it develops and publishes games and services through various genres such as sports, racing, first-person shooter games, action, role-playing, simulation, primarily under the Battlefield, The Sims, Apex Legends, Need for Speed, and Plants vs. Zombies brands, and licensed games from others, including FIFA, Madden NFL, UFC, NHL, Formula One, and Star Wars brands. The company also provides advertising services and licenses games to third parties to distribute and host its games. Now, it markets and sells its games and services through digital distribution and retail channels, as well as directly to mass market retailers, specialty stores, and distribution arrangements. Now, let's go ahead and look at some of the news that just hit the company over the couple days. Electronic Arts stock rose following a strong quarter. According to Zacks.com, Electronic Arts reported a second quarter fiscal year earnings of $1.02 per share, which increased 62% year over year. Now, revenues increased 58.6% year over year to $1.83 billion, driven by strong performance by the EA Sports global football franchises, Apex Legends, and Star Wars Galaxy of Heroes. The exact consensus estimate for earnings and revenues was pegged at $1.17 per share and $1.85 billion respectively. Now, the net bookings surged 103.4% year over year to $1.85 billion, better than management's guidance of $1.725 billion, driven by robust live services performance. Now, let's go ahead and look at some of the fundamentals of the company. Now, the stock is currently trading around $145.59 a share right now, with a market capitalization around $41.1 billion. The fiscal year projected revenue should be around $7.69 billion, with a positive $758 million in revenues. The projected revenues for 2023 should be approximately $8.17 billion, with a positive $1.18 billion in earnings. Now, looking at the growth rates analysis, Electronic Arts saw earnings decline slightly in spite of positive revenue growth during the past 12 months. Additionally, the average company in the entertainment industry was able to improve its earnings result over the same period, but earnings are expected to grow significantly over the next 3 years, and they are high quality earnings, so I'm not too worried about that. Now, looking at the valuation analysis, because Electronic Arts is in the entertainment industry and has positive earnings, the price to earnings growth ratio, the price to earnings ratio, and the price to book ratios are the most appropriate valuation measures. Now, the price to sales ratio is less instructive than the price to earnings growth ratio or the price to earnings ratio, since the company has positive earnings. Therefore, Electronic Arts seems fairly valued with the price to earnings growth ratio 1.97 times. That is in line with the entertainment industry's median of 1.91 times, although their price to earnings of 53.24 times is above the industry median of 26.07 times. Now, let's go look at the profitability analysis. Based on its gross margin, operating margin, and net margin, Electronic Arts converts a larger percentage of its revenues to profits than most other companies in its entertainment industry. Furthermore, the company is profitable with an operating margin of 17.01%. Now, looking at its financial strength analysis, Electronic Arts' short-term assets of $3.4 billion exceed both its short-term liabilities, which is $2.6 billion, and its long-term liabilities of $2.6 billion. Now, Electronic Arts' debt to total capital ratio of around 19.29% is in line with the entertainment industry's norm. Now, the company should be able to comfortably repay its debt given its interest coverage ratio around 24.29 times. And it's important to note that shareholders have not been meaningfully diluted in the past year. So let me bring it back here. So what do the analysts say about this one? Well, the analyst consensus right now is a strong buy with a 12-month price target of $174 a share, with a high value of being $200 a share and a low value of $152 a share, above the current $145 a share that's currently trading at. Now, going over a few of the analyst reports, by the way, the new Constructs, which is a fundamental analysis report, they do not recommend investing in Electronic Arts right now and give it a neutral rating, meaning that the stock's upside potential is equal to its downside risk, so they say. Now, the Street Quant Ratings rates Electronic Arts as a buy. Now, this is driven by some important positives, which they believe should have a greater impact than any weaknesses and should give investors a better performance opportunity than most stocks that they cover. Now, the company's strengths can be seen in multiple of areas, such as its revenue growth, largely solid financial position, with reasonable debt levels by most measures, reasonable valuation levels, good cash flow from operations, and increase in stock price during the past year. Now, they feel that its strengths outweigh the fact that the company has had somewhat disappointing return on equity. The Ford Research Company has a hold recommendation. Their hold recommendation, Electronic Arts, is the result of their systematic analysis on the three basic characteristics that they look at. They look at earning strength, the relative valuation, and recent stock price movement. Now, the company has enjoyed a very positive trend in earnings per share over the past 5 quarters, and while recent estimates for the company has risen by analysts, Electronic Arts has posted better than expected results. Based on operating earnings yield, the company is about fairly valued when compared to all the other stocks that they cover. Share price changes over the last year indicates that Electronic Arts will perform in line with the market over the near term. So am I a buy, hold, or sell recommendation right now, Electronic Arts? Here are my thoughts. Now, Electronic Arts franchises are very durable and many of the sports games face no real competition. Now, this allows Electronic Arts to grow easily alongside the broad video game market right now, which is projected to grow at a compound annual growth rate of 10% per year through 2026. Now, what I love about Electronic Arts is that it's using a strong cash flow to acquire other gaming studios constantly. I believe that if Electronic Arts can intelligently use those acquired studios, the company should be able to grow its overall sales by more than the industry average over the long term. Now, this also tells me the company is always forward thinking and how to stay on top of the next gaming franchise craze. Now, its current pipeline is extremely strong. The timing of the new releases can make it hard to compare video game developers' sales in any given period. However, Electronic Arts clearly has a strong momentum heading into the holiday season of 2021. Net bookings more than doubled this quarter to $1.8 billion. Electronic Arts has an engagement and monetization with its subscription services, anchored by its dominant position in the sports niche through franchises like the FIFA and Madden. So based on all of that, I am a strong-term bull on Electronic Arts. Now, I would wait to the next small dip to buy into this stock, around $135 a share, so to speak, and hold for the next 5 to 10 years. Yes, folks, 5 to 10 years to get the most out of this growth stock over the years to come. I put a price target over the next 12 months, about $175 to $180 a share. But here are a few of the downside risks to my bull thesis. If, and I mean that's a big if, Electronic Arts' pipeline of new releases ever weakens, where its direct rival Activision might step in for the kill. Activision, I'm sorry, not Antivision. But I don't see that happen anytime soon because Activision currently has a weaker content pipeline right now. So there's a chance Electronic Arts might close the gap with Activision right now. But my thesis is competition between Activision and Electronic Arts is a good thing for the consumer. And I believe that both of them can win at this game. So there you have it, folks. And as always, don't forget to smash that like button down below and consider subscribing and hit that notification bell if you'd like to hear daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.